Hi, my name is Eli Settle. So my dad left and he left his computer on, so I'm taking over for today. And trust me, I got everything under control. I hear my dad and he talks about it and he teaches me, and I know better than him. And we're gonna talk about the market, the stocks, and lines, colors, numbers, and all that stuff. So let's get started.
Today is April Fool's Day, April the 1st, 2022. My name is David Settle, not Eli, and this is the Market Outlook from MarketScholars.com. I will be doing the Market Outlook today, and not my son, so you can stay with me for the rest of the video. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, and finish the day a small range day again, but finish the day on a much better note than where we were going. Nice little push at the very end, almost like an April Fool's kind of a day, right? The momentum line did come out. They were both in extreme levels. At the lows of the day, both these lines were at extreme lows. The momentum line jumped back up because of the rally today. Because we didn't get another day at the lows like we did yesterday, close at the lows. The near-term line, however, came down because we traded within the low point of yesterday's range. And we did get a lower high and a lower low. So it did bring that near-term line into bearish territory. So again, this is a near-term decline. It still hasn't broken the 23% retracement of the near-term rally that it's pulling back from. Which is just fascinating. Again, it goes to show just how strong the bullish moves. And really, the bullish moves, anytime we get bullish moves and bullish postures, lately, the markets just can't give any of it back, right? That's part of the problem that the markets have, is that they can't exhale. Every exhale when you're in a bullish posture, dark green shading and green line, is just very, very minimal until we get into and full on, exhale with these dark pink shading and red lines. That's what creates the bigger exhales and what a lot of people are comfortable with, because we can't get the normal exhales. And you can see that already. Again, not being able to break 23% when you don't really get retracements normally until you do break 23%. Again, goes to show just how how bullish we are, number one, and how we're unable. Maybe the market is just unable to do that, right? It's unable just to come down to 38 and bounce, and without having to come all the way down, right, and just go nuts, without people going nuts. So you can see the PPO still we're still 3%, almost 4% up above the moving average. So we're still strongly bullish. Dark green shading, green line, right? It's still easily there, and we're setting up for a bounce off of a low point, off of a higher near-term low. Now the problem is, because it's not very much of a low, we're probably not going to get very much of a new near-term high point. You get more if you pull back more. You get more to the upside. It's just the same thing. Like you think about inhaling and exhaling. Like when you inhale to the downside, you get an exhale back up. Then you get more of a decline down. But as the inhale or the exhales get smaller, the new inhales get smaller. And the same thing here. This would be a very small exhale. So you'd expect a smaller inhale to come off of this low point. So that's what we're getting right now, and not necessarily the best sign, but it is what it is, right? The markets we get what we get from the markets. You can see the Russell 2000 not back up above that resistance level, and the same thing. We were at extreme lows on the short-term sentiment, and then they bounced up there, and then your Nasdaq's going to look very similar, right? Strong bullish posture. We were at extreme lows at the lows, and then we bounced back up, and you can see the PPO, like the distance between the stock and the 30-day moving average. Now the average, you can see the 9-day average of that PPO is about as high as we got over here, and we are now below that, well below that number. Again, we can converge until we break the 30-day. You can see we can just kind of converge here, and so that doesn't necessarily mean we can't go up. It just means that we're going to be limited when you are in convergence mode. You can see on this entire time here, when we fell below the moving average, the MACD dropped and the moving average dropped, but we were going up the whole time. And now, granted, from the peak to the time that we finally dipped to zero here, we pretty much just went sideways, right? We were up and down, but we pretty much went sideways for about a full expiration cycle. and then we rallied up again, right? Then you can see the MACD got above its moving average and went up again. Same thing here. We peaked. The MACD peaked right there. Then we started to converge, and then the MACD, we eventually got to the 30-day moving average over here. We went up for a while. So again, we peaked. The histogram peaked. The PPO peaked. We're flirting. We're actually slightly negative, so we're slightly below the moving average. So we're probably going to converge for a while. And again, it doesn't necessarily mean that we're going to stop going up. It just means that we'll probably just kind of go sideways or just slow it down so that the moving average catches up while we're in this convergence mode. You can see a very similar pattern over here, right? We were in convergence mode for a while until we finally got below the 30-day moving average, and then things kind of got more bearish there. So that's considering that we're 5%, or the PPO is, not 3%, 5% above the moving average. We're not going to be falling off a cliff anytime soon here. Let's take a look at the weekly versions of the market forecast chart. So again, the expectation is that we'll start to slow down. We won't necessarily go down. The moving average will catch up. If you look at the weekly version of this chart, you can see there's kind of a similar phenomenon occurring here, right, where we still stayed bullish, even though we were kind of in convergence mode. We are above the moving average. We're not that positive, though. We're just we ended up the week with a long upper shadow, relatively, long upper shadow, and right at that resistance, right at the 62% retracement on SPX. So it'll be interesting to see if that ends up being something of a reversal pattern. The near-term line did get strongly up above 90th percentile, and the intermediate line did come back up out of 40, so that's a good sign. The Russell 2000, when we take a look at it, a little bit of a doji pattern there. Again, right at resistance, long upper shadow too. Right at resistance there. Near-term line got into the reversal zone, and so far is okay. The PPO is still actually negative. We're still below the 30-week moving average. When you look at the NASDAQ, it's the same thing. We also are below the moving average, even though we're above. The PPO itself is above its moving average. But as you look, when we look up here, again, the 62% retracement held with a little bit of a long upper shadow again. So, in a very small body. So really important to see how we resolve that long upper shadow next week, because right now you would consider it more of a bearish sign. Not that we'll go down too far, but until you get a better candle, that means the bears kind of finish the week with the upper hand. Even though the bulls kind of got the upper hand here at the last hour or so trading, for the end of the week, the bears had the upper hand here. That's what the upper shadows tell us. That's why the upper shadows are longer upper shadows, relatively speaking, again, right, relative to the body, tend to be more bearish. So look at this weekly chart. You can see, again, a good bullish candle. The Hakinyashi close ended up being above the high, so that's good. We're going to open up right around 44.82. We're at 45.45, so we're going to get a good bullish candle next week. Though, where the close ends up being is a different story, considering the high is at 46.37. So now the likelihood of closing above next week's high on a Hakinyashi close, not the actual close. And the Hakinyashi close is at an average of the open, high, low, and close of the regular candle. We'll see if that ends up being the case. PPO is really high between the 10 and the 40-day moving averages. The Hakinyashi differential, the candle itself, which means we'll start getting smaller and smaller candles. It's hard, you get the bigger candles right when you're starting, and then they start to get really small. The ranges get really small. And the PPO itself is only 1%, so it's a relatively small number itself. Never did cross below zero there. Now, it did on the Russell 2000, of course, and we've been below for a while. We're still pretty significantly below, and you notice we did not close above. For the second straight week, we did not close above the prior week's high on a Hakinyashi close. The NASDAQ 100, you'll notice it did. It barely did. And you can see it's the size of the candle is also pretty darn high. I mean, it's almost about as high as it was the size of these candles when we were coming off the COVID low point. So again, that's going to limit the size of the move going forward if we continue to grind to the upside. So you look at the three green arrows. We still have green shading all across the board. We had a red arrow on the MACD over here on the IWM earlier today. We do not have it now. So still three green arrows everywhere. So again, we're on an intermediate run. Whether we'll get up to a higher intermediate high than the last one, that would be all-time highs, right? That the likelihood of that's not very high, and the likelihood of this intermediate run being one of those that just lasts a month, right? So pretty much till April expiration, till the middle of April. That's kind of the more likely scenario of our 3 green arrow, of our intermediate posture. You can see we have 3 green arrows, but you can also see too that we're kind of flirting with that 8-day moving average. And like I said, that MACD histogram's already peaked. The MACD itself is peaking. This is actually the PPO, the relative MACD, but it's also peaking at a higher level than what we had seen previously, and now it's getting below its moving average. And again, like I mentioned here, it can start to converge and still go up and still be above the 8 and 17 days. It's not until it gets below the 17-day that it starts to diverge to the downside. And obviously we're not there yet, and we're getting a crossover on the stochastics inside the upper reversal zone. So, we're hardly bearish here. We're just probably not as bullish anymore. It's going to really limit any upside moves. The Q's actually held the 200-day moving average for resistance, as well as that 62% retracement, and we're moving towards a divergence, or at least a bullish convergence there. And then IWM actually did break its 8-day yesterday. It got back above it today, but you can see how close it's a lot closer to breaking its 17-day than the others, and it has crossed below. The MACD has crossed below its moving average. So it's a little bit more precarious than the other indicators are. Like I said, you got that breakout earlier in the week above the 38% retracement and that long-term 23, and it really did not hold. So that's a little bit of a bearish sign on the Russell, that we're not seeing nearly as bearish of a sign on the other indexes, on the S&P and the NASDAQ. Looking at some of the other oscillators for SPY, we're not back below 25 in the positive, but we're not above 30 anymore. So we're not really in breakout mode, bullish trending mode. That's when you're above 30, right? You're above 30 and you're really pushing higher. So we're not above 30 anymore. We're not below 20 on the negative either. So we're not bearish, but we're also not bullish. You also see same thing here. We're back above 20. We're not quite below 25 yet. So we're not bearish, but we're not bullish anymore. And the IWM is just really neutral. It actually is below 25. It can't get above and stay above 25, which is what you need to be bullish or bearish for that matter. And you can see the negative indicators won't go below 25. So it can't really, establish any kind of trend. It's very trendless right now. When you look at its indicator here, we can't get anything going above 50. It's very noisy. We're back in the cloud after this kind of false breakout, back towards that green line. The Qs have held the top of the cloud. You can see we're coming down the top of the cloud there for a resistance. And then SPY, again, it's got this. It's the better index of all of them. It's above the cloud. It's above the green line still, especially with today's close. And there's a big gap between the green and the blue. That's how fast we've moved. The red line is above price, not above the cloud, but it's above its price. And we do have an intermediate trend going here. We just don't have a very strong one. And if you look at the Qs, we're also in an intermediate trend, above 2, above 65. Just not a very strong trend going yet on that. From an RSI standpoint, you can see SPX back below 60, the CCI back below 100. So not bullish anymore, not bearish either. And the Russell 2000, same thing, and the NASDAQ 100, same thing. Again, not bullish anymore, but not bearish yet either. Just really limiting. And we talked about this in the technical analysis class today, the size of this bandwidth, really, really high. It opens you up to big moves. When you have a big bandwidth, you can see it opens you up to big reversals in either direction, right? Whether it's a downside or an upside. It opens you up to big reversals, and it also opens you up to a consolidation, right? Where, when we peak here, we start to consolidate when the bandwidth comes down, and we just end up coming, we kind of went over 2 expiration cycles, kind of just went sideways here, ups and downs within this volatility, but ultimately sideways. So, you got the same thing. We're not breaking out of this from a low bandwidth to where we can really get going. We're breaking out here with an already very high bandwidth, already above 10, which is high for the S&P, is relatively high. You go back, here's outside of the COVID move, and then you can see fourth quarter 2018, a little bit higher over here, and you can see also over here in 15 and 16, we got up to about 15, or just under 15. So it's not very common for the bandwidth to get bigger than what we have right now, which means one of two things: we're opened up to bigger moves in both directions, because of how wide the bandwidth is, and we're also open up to consolidation, to where the bandwidth eventually comes down, and potentially in this case, remember, we were breaking out there, and then we just went sideways for quite a while, for two expiration cycles, as the bandwidth came down at that point. All right, so let's take a look at today's intraday move here. Again, lower high, lower low, but look how small the range. Extremely small range. We really had some small ranges this week, and again, we're above the value area in the 4 weeks. We're above the point of control, so we're really bullish from that perspective. IWM is also above the point of control, though not above the value area for the 4-week chart. It's been less bullish. And then the Qs, the same thing as IWM, inside the value area, but above the point of control. Lower high and a lower low, and we actually did close below the low, yesterday's low on the Qs. Not by much, and we stayed pretty much right at last week's high. IWM, we actually closed below last week's high, so we closed back in last week's range. And then SPY, you see, also right at below last week's high, right at the top of the range there. When you look at the amount of volume we had today and the range, again, 89 million down from yesterday, very small range, 4 points, and that continues to bring both these lines down to almost 1.5% on the average ATR, so 4 points way down here, and then the 89 million is right there. So it's bringing both these lines down. That's bullish, but we're not really trending bullish. We're not established in a persistent grinding trend to the upside until we get back below this 1% level on the ATR, which means we need more and more days below, like today, below 1%, which is 4.5%. That's a good 8 range today. We kind of need to get that number down. Otherwise, again, like I said, with the wide bandwidth, you're opened up to bigger ranges and bigger moves when you're up this high. One more look at volatility. You can see volatility finished the week extremely low, below 20. But then this number here is it's about, it's one of the lowest closes. I mean, look how fast we fell. We talked about, how these candles, when you open above 105 and close below 100, that they're bearish for volatility. We see these and usually get a drop in volatility that comes out of them. You see a lot of examples of this. Another one right there, and one right here, and then now this one. And we really dropped pretty sharply, a lot faster than these others. You can see it took longer to get down, and we stayed above 20 when you got to 80%. Over here, you only got to 85 and stayed there, again staying above 20. Here we're just a smidgen below 20, and we are to extreme lows. 80% is a really extreme low. And when you look at, this is what really stood out to me, the skew. Look at the jump in the skew. What this is saying is, this is demand for way out of the money puts. What this is saying is, the market, like you can see these other peaks, when you get these other big peaks, you're not necessarily bullish. They tend to line up with peaks in the market, depending upon where you ultimately peak out. You can see here this week got some volatility at the beginning of the year as a result of that, and you can see we peaked on volatility right about these levels over here going into that pullback period in September and October. So usually when you get a rally like this, that's a good, we drop down, the VIX drops down. We never did drop down below 120, which is a sign that the correction is over. And we jumped up. When we get a rally like this, we jump up. But the fact that it's already jumped up so far, I mean, we're kind of spoiled here, because the normal range for skew is not to be this high. Usually when you get up this high, it's not really a good sign. So the fact that it's already up this high again this quickly throws you off just a little bit. You notice the new highs and the new lows today. We never did break that 100 barrier that we talked about, getting above 100 this week. We got positive, but we're right back to negative now. Not very negative, so we got to get below minus 100, and really even a little bit more below that to really get going to the downside. Probably going to be more like 250, 200, 250 in that area to really get going to the downside. But you have to get above 100 to get going to the upside, and probably even more than that too, like more like 200 or so. But you can see, this isn't the only time we've been positive on this current bearish trend, pretty much since before Thanksgiving started. It's not the first time we've been positive. So it's, from this chart you can tell we're not quite there yet in terms of really breaking to the upside. There's still, according to the VIX 3M still being high, and according to, you can see the VIX 3M here, it's still at 24. So it's not dropping like the VIX is dropping, right? So according to the VIX 3M still being high, and according to the skew being really high, the market's still concerned about fat tail risk, right? Big moves, big down moves. And the more that we go up like this, and especially kind of the move with today, is even more concerned about that. And we all know why, right? It's that yield curve inversion that's really kind of throwing people for a loop here. All right, so to summarize the technical outlook, again, we're not bullish. I think that phrase summarizes it. We're not bullish anymore, but we're not bearish either. But the markets are still very concerned about that bearishness. So we're not, this correction that really hasn't even started on the S&P is not over with. As nice as this bullish move has been, we haven't seen the signs of, first of all, we haven't seen the signs that we even started a correction. And second of all, we haven't seen, aside from the NASDAQ and the Russell, which have started a correction, but we also haven't seen the signs that we typically see when we've ended a correction, and from a technical standpoint. So we got a nice little bounce, but it appears that this bounce is probably over with. Doesn't necessarily mean that we're going to tank, but it does mean we'll probably start to converge over the next week or two going into April expiration. After that, then I think that we're headed back towards a bearish posture again. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know if there's any charts or indicators that you're looking at that would tell you why you're either a lot more bullish than I am or a lot more bearish than I am. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked our video today. And two, you want us to do another video again tomorrow. It's a quick way to give us some feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, you can check out some of these other things over here. Click on this icon, takes you to our Market Outlook live page. You can also get to it by clicking on Market Outlook Live Trade Review in our menu. On Monday, Wednesday, and Fridays, including today at 3:30 Eastern Time, I do this live video on this page, a quick 10-minute, 15-minute video. I take a look at all the trades that we're still in from other Market Outlook videos. We take a look whether we should get out of them or stay in them. We also put on today's trade already before the market closed for the weekend. So we did that today as well, again, in this video, so you can check that out here as well as all the archives as well. Come down here, you can see our upcoming classes. We got a full slate for April, off for the Good Friday weekend, of course, but we got a full slate of classes, and of course we've got 4 years worth of recordings that you can check out there. You can also get to that here in our trading room on our main menu. Come down to the bottom, click on that heart. It opens up this tab, hit that like button. Also click on that thumbs up icon, open up that tab. Hit that like button as well. Again, the more you do that, it helps get our content out to all of our followers. The more content engagements it has, right? Likes, comments, shares. It benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to actually engage with us right here while you're watching. All right, so let's take a look at what's driving the price today. And you can see, at least this week, you can see the big moves have been in long-term bonds to the upside, gold and commodities to the downside. So kind of that inflationary trade, but in reverse, right? Bonds or commodities and yields down. The dollar actually was ended up down. The dollar's actually been up during some of this inflationary moves. And then, of course, gold's been down. So that's kind of, and then you can see from an equity standpoint, emerging markets were your best performers for most of the week. Again, from an equity standpoint, you can see the NASDAQ 100 actually started pretty positive before finishing lower below emerging markets with, to the last couple of down days there. And you can see emerging markets too, or excuse me, IWM was a pretty good mover in the first 2 days of the week, and then they finished down along with the S&P 500 over the past 3 days. So good first 2 days, but with again the same thing, long-term bonds up and commodities or the commodities and gold down. But then after, if you look at this, the last 3 days, so from the 30th on, you can see commodities, gold, and bonds all rallied, and equities were the big losers, down 2.5–3% before a little push here at the end of the week, got everything higher, and emerging markets really outpacing. So you can kind of see how it was a tale of 2 weeks per se, and really what the biggest mover, the biggest change that we had in the last few days was, you can't really see it there because it got some spike there, but you can see one of the biggest changes we had this week was the here, let me see if I can just refresh this page and see if that helps. Was the drop here in the yield spread. Let's see here. So here's the 28th, 29th, and then you can see the drop down 30th, 31st, and then today. That's the biggest move. We went from being below. We dropped below 20 at the beginning of the week, and I talked about before the tranches. This moves in. When you have 20 basis point tranches, when you break the one level, when we finally broke below 20, we hit 0, and we hit it fast, and then now, of course, we've broken below 0, and we finished the week down 8 basis points below 0, an inverted yield curve, and other, like the 2-year and the 30-year have inverted, and so you're getting more and more of the yield curve inverting. You can see the 2-year essentially is up to 2.5%, which is obviously where the 10-year is, near 2.5%. The 3-month hasn't really gone up very much, so the 3-month is still waiting for the Fed to do something, and you can see the odds for the Fed to do something are really ramping up. You can see we have a 73% chance that we'll get 2 rate hikes in May, so that would be 3 total, including the one that we have in March. So 73% chance we'll get 2 in May, and then if you go out to June, you can see we have 100 minus 21.2, a 78.8% chance of two more hikes. So that would be a total of 5 in June. And then now here is the issue. Like because if you go out to December, you can see the odds are really high. 96.2 for 9 hikes. That is, there's 7 meetings from March to December. So it's a hike at every meeting, with 2 meetings having 2 hikes, so 50 basis points. So that is 96% chance of that. So there's 96% chance that we're going to have 2 hikes in 2 of these meetings. Again, most likely May and June. But if you go out one more, there's a 75% chance we're going to get 50 basis point hikes in 3 meetings. And again, you would expect it to be May, June, and July. If I were to go out to July, you can see the odds of 6 hikes, right? So that would be 1 in March, 2, 3, 4, 5, 6 are 92%. So there's a 92% chance that we're going to get 2 50 basis point hikes here. And we've seen this most likely going to be May and June. And then you can see for July, we're at 55.5. That we'll get, that July will be the next one. And just goes up from there, like I said, to December, where we have a really high odds of getting 10 hikes. So 1 at each meeting plus 1 more at 3 of them, for a total of 10 hikes. 2.5%. And again, that's where the 2-year note is. And if you look at the gap between the 2-year and the 3-month, and it has, let me see if I can refresh this, because it's a pretty decent move today. So here we go. Here is the as far back as we got for both of these, and we are really, really low going into, this is March 31st, so this does not include today. So we're at 176 basis points today. But if you look at the 2-year at 2.46 minus 0.528, so 2.462 minus 528. Then we're looking at 193 basis points. I thought maybe this would be updated, but it won't be updated until apparently after. But 190, what did I say? 193 basis points. Again, we're close to 200 basis points. Again, last time we got this far, the gap was this far, was when we were dropping the 3-month rate with Fed rate cuts, right, during this 2002 period. You can see in 2002, let's see if it goes, yeah, it goes out. We were dropping rates here, and eventually we dropped rates at the end of 2002 by another 50 basis points. It was there was another 25 in 2003, but at the you can see we really went down, especially after 9/11, and we had that last cut there in 2000, and we had that last cut at the end of 2002. So that got us down to that level, right, in 2002. Eventually, by the end of the year, we were actually back up here into this range. But we were really, really down coming out of 2001 with all those rate cuts through 2001 that really pushed us to a really low level. We're not cutting rates and bringing the 3-month down right now. And the 2-year said that we were cutting it too far. And that there was some criticism, right, with the housing bubble that came out of that the Fed cut rates too low and kept it too low. Well, that's what this was telling us, that the Fed cut rates too low and kept it too low because the gap between the 3-month, which is typically where the Fed is, and the 2-year was really big. Well, here we are again, same levels. But the difference here is the market's not telling us the Fed's cutting rates too low, and keeping them too low. The market's saying we're not rate, because we're in a rate hike cycle, not a rate cut cycle. We're not hiking rates fast enough, according to this. And so, again, markets typically aren't too bad during rate hike cycles, aren't too bearish during rate hike cycles, but we're also not 200 basis points behind in those rate hike cycles. With a real Fed funds rate, with a CPI that's above 5%, which is typically bearish. And then also, you can see it's all these other 5% marks post the 50s, the early 50s, all the 5% plus marks are all during recessions, right? So there's that, and then you have a real Fed funds rate that's lower than we have on record. So not your typical rate hike cycle, and I think that's what's putting the damper here by the end of the week now that the curve is inverted, and you can see that long-term bonds finally rallied, and long-term bonds are really, really down right now, but it appears that we closed back after opening way down at the close today. We rallied up and finished above the 17-day moving average, with the MACD already above its moving average and rising. Stochastics is making a run up to the upside. So it appears like we may be starting to get a little bit of a bearish divergence on this, bearish convergence, and a bullish divergence to the upside. Here's the weekly version. Here, let me go to a weekly chart, sorry. Here's the weekly version of that, and you can see the MACD may be bottoming on this as low as it is, and then the histogram turning up, and you can see a good bullish reversal pattern there. As far below these short-term averages that we are, looks like we might be setting up a low point here with that. That's the benefit of an inverted yield curve. It doesn't necessarily mean that the market's going to be bearish, but it does pretty much put a ceiling on rates, on long-term rates especially, because it's hard for them to go up without short-term rates going up too, and it's hard for short-term rates to go up too much further than the long-term rates, because it's hard to get too inverted, and so that's, the Fed's got, usually short-term rates will go up when the Fed's raising rates, but there's 200 basis points practically for the Fed to raise before it even gets close to the 2-year note. So we're not anywhere near to the point where the Fed can actually start to impact those short-term rates now that they're inverted, right, with the long-term rates. So essentially, that's going to put up a ceiling here, and it's going to probably going to get the 10-year yield probably back down towards 1.75%. I don't think it'll go bearish, but back down towards 1.75%, which would be bullish for bonds in that case. And I think gold also, as we saw at the end of the week, will hold up better during this environment. This is the weekly chart, but here's our daily chart, and you can see, we came down to the 50-day moving average. MACD's coming down. You would expect it'll probably start to turn around and move back up here and make a new leg higher. Probably won't go as fast, but we'll probably get back up to this area a lot slower. Probably over a few expiration cycles before we get back up into this zone, this $190 zone again. Let's quickly look at how the sectors performed this week. First of all, in the first 2 days of the week, whoops, not that one, sorry. On the first 2 days of the week, lots of green shading, dark green shading there, right? That's great. But let's look at the comparison here. And again, just look at this week alone for the whole week. And you can see initially it was technology, discretionary, communication services. Those were the biggest oversold sectors during the pullback, and they rallied. Energy has been a very strong sector during the pullback. It pulled back, right? So not surprising. That's the first few days. And then you look at how we finished the week. Technology, communication services, discretionary down 3.5%, down 2%. Industrials and financials were down. Financials really do not like inverted yield curves. They're struggling. And you can see, your safe haven area is doing well. So we started the week risk on, but it was a bounce. It was a continuation of that bounce in areas that were so oversold. We finished the week not so risk on, right? More risk off. And financials, like I said, they're the ones that are going to really hurt. You can see XLK looks very similar to the S&P 500, but if you look at XLF, it looks a little bit more bearish, right? We're back flirting with that point of control again. And if you can see XLF, if I zoom out to the 2-year, there's an important shelf of volume here that there's not a lot. We've converged for so long on that 30-day and 200-day. If I were to change this MACD down here to the 30-day and the 200-day simple moving averages, we'll go simple there. You can see we got so bullish here at the peak of in June. By June is when financials really peaked in that long-term basis, and we've been coming down ever since, right? So there's the gap, and you can see we're below its moving average and really rolling, still below the moving average, and now gone negative. The 30-day slightly below the 200-day. So that kind of gives you an idea of the convergence that we have going on right now. You can also see that too if I were to go to a weekly chart and then come here and do the 6 and the 40 week, and we'll do that exponential. You can see that same concept, right? We've been converging for so long that you'd expect, especially you can see we're breaking below the 50 week this week, but especially breaking below the 30 again, that look how much of a correction, like that's how much room we have to correct if we do correct, right? We corrected in fourth quarter 2018, we corrected during COVID and actually went down into bear market territory during COVID. That's a big move to correct. We were so bullish. There's a big gap there between the now 10 week and the 40, right? So that's such a big gap there. Now we're starting to move lower. You would expect that we'll start to converge there. Here's what the 50 and the 200 look like when you put the PPO there. Like, look how big we got, and we are below, and we're below the 50 now. We're not below the 200. That's when you get a divergence going. So we're converging. So you'd expect when you converge, you're going to be below the early, like you're going to be below the MACD and you're below the short term, and not the 200. So kind of similar how we were here with that 8 and the 17, 8 and 17. We kind of just stalled. We were converging these short-term lines with the 50. And now you expect we'll converge that with or correct it at least, between the 50 and the 200. So there's very, very poor margin of safety in the financial sector. Our trade idea is a stock that's got a similar setup. It's the ServiceNow You can see it's also very bullish between the 50 and the 200 week moving averages, but the MACD is below its moving average and it's falling. It's way, way high, and it's falling here. And we're below the 50 week, and you notice we're also below the 17 week and now the 8 week. So very similar to what we see with financials. Obviously, it's a different company, but that's the kind of stock that has been kind of rolling over. It's had a good bullish run like most stocks. But this one, unlike others, didn't get the intermediate line above 80 and potentially is peaking now with the close below, lots of lows here. And this is, again, what the stock market looked like. Very bearish short-term sentiment. Intermediate line in bullish territory, but not really getting bullish levels up above 80. So not looking so good. When you look at some of the other oscillators, we are below the moving average. The MACD, the negative indicator didn't stay negative for too long. The positive indicator obviously didn't stay positive for too long either. If you look at the RSI and the CCI, they got into that kind of fake out territory above 50 but not above 60, and now back below into the lower half of the chart. Same thing on the CCI. When you look at the Ichimoku cloud, we dip back down below the cloud after getting trying to get a fake out type breakout above, trying to get a breakout above, but looking like a fake out to the downside. And then finally, on the Bollinger Bands, really wide band. You get big moves inside of wide bands above 20%. Remember, the S&P was only like 12 or 13%, above 20%. So big wide band, and you're breaking below the point of control and the big volume node, and not as much volume below. So it sets us up for a potential move to the downside. We didn't look at the daily chart on this, but you can see we're still below the 200-day moving average. We filled in the gap between the 50 and the 200, came back below all these moving averages now, and you can see the bearish divergence setting up well below the 17-day and MACD below its moving average as well. So setting up for a bearish move to the downside. So we decided to do a long put vertical spread, buying the 490 put for May, selling the 480. That gets us to a normal position size with about a 3-to-1 reward to risk ratio. So it limits my risk to the upside if the stock does bounce back up. Gives me a good return to the downside if it keeps moving as we expect it would, and well within range of one standard deviation if it were to keep going down. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below. Also, join our website at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.